state the obvious, but sometimes the obvious is not so obvious, so I don't mind. The key is diversification, and everyone says, oh, of course, diversification. Actually, there's good, kind of empirical proof behind that. But the problem is people don't understand diversification. I run into people that go, oh, I'm highly diversified. I got 50 stocks in 10 different sectors. I got technology and consumer non-durables and all this. And I look at them and say, you're not diversified. You may have 50 stocks in 10 sectors, but you have one asset class. And that asset class has a conditional correlation in financial distress. They'll all go down together.
What do you mean by diversification? Diversification is the act of investing in a variety of different industries, areas, and financial instruments, in order to reduce the risk that all the investments will drop in price at the same time. What is diversification with example? Image result for diversification. For example, an auto company may diversify by adding a new car model or by expanding into a related market like trucks. If a company is expanding into industries that are unrelated to its current business, then it's engaging in conglomerate diversification.
So real diversification, have a slice of stocks by all means. Have some land, have some real estate. I like that. I recommend a big slug of cash, 30% for the reasons I mentioned. Have some alternatives. Got to be very selective, and some of the good funds aren't open, but there's room for that. A lot of my portfolio is not in publicly traded equities. It's in some technology startups, risky, but I find them very interesting. And gold. And I recommend a 10% slice for gold. I recommend physical gold because if you don't have it in safe storage, you don't actually own it. Most of what people call gold is paper gold. They're ETFs, they're gold futures, etc. And people love to put words in your mouth like Jim Rickards says, sell everything and buy gold. I've never said that. I don't think it's the end of the world, but I do think 10% is the right slice. But if you have that portfolio, 10% gold, 30% cash, 10, 20% real estate, 20% equities, I'm not doing the math in my head. I don't want to go past 100, but the point is that's real diversification with much lower correlation, even in distress.
All right. What is the best definition for diversification? Diversification is a strategy that mixes a wide variety of investments within a portfolio. Diversification limits portfolio risk but can also mitigate performance, at least in the short term.
Yeah, you should have dry powder. The question is, where do you store it? But I find forecasting Fed policy is the easiest thing I've ever done because they can be relied upon to blunder every time. Like just figure out the worst thing to do at the worst time, and that's what they'll do.
That's very true.
But we're watching a movie we've seen before. So here's what's going to happen, because here's what did happen. May 2013, Bernanke announces the taper. He didn't use the word, but he implied that. November 2013, they start the taper. November 2014, they finish the taper. No more net purchases. And then we get ready for the liftoff. March 2015, Yellen removes the word patient from the statement. That's your clue, that's your magic word. We're going to raise rates. But they didn't raise rates, pardon me, until December 2015. It took that long to raise rates, but they did. And the next 25 basis point increase was December 2016. At that point, they got a little mojo, and then they kept raising rates. Jay Powell comes in. He raises them throughout.
Trump became president, so they expedited the tightening.
Right, 2018, and you're up to 2.25. What happens next? From October 1st to December 24th, 2018, the stock market fell 20%. In other words, the Fed proved that they cannot normalize. They proved that they cannot raise rates, they cannot reduce the balance sheet, they cannot do what they want to do. And nor can they get inflation, because they never did. So we saw that whole movie. Now, what are they doing now? So then they do it in reverse. We had the Christmas Eve massacre, 2018. Then the week between Christmas and New Year's, Powell gives some kind of speech. Says, I guess we better stop raising rates. That signaled that.
He said that he was wrong when he was a rookie about quantitative easing being a bad thing.
Well, at least lawyers look at both sides of the issue. It's good. The only thing good about Jay Powell is he's not an economist. I consider PhD in economics to be a disability if you're actually trying to figure out what's going on in the economy. But so then 2019 comes along, and Powell progressively lowers rates. And then the pandemic, and he gets back down to zero. Okay, so then a year goes by. What are they going to do? we're going to taper. And they are. In November, they'll start the taper. They'll finish it by June of 2022. And then we'll get ready for the second liftoff. They're doing the same thing over again. And they already proved they can't do it. So as they proceed to do it, except one difference, the market saw what happened between 2013 and 2018. They watched the same movie the rest of us did.
Yeah.
So pardon me, they're anticipating the ending. They know how this ends. So the correction will start soon. Now, just to be clear, the S&P is in a huge bubble, an historic bubble. That does not mean go out and short the S&P. That's a good way to lose money. I analogize it to, there's an 18-wheeler coming down the road, 80 miles an hour. It's heading over a cliff. You see the cliff, you see the truck, you jump out in front and say, hey, stop. This truck's not going to stop. You're going to get flat and you're going to get killed. So shorting the S&P is a really good way to lose money today because bubbles, people say they can't see bubbles. Bubbles are easy to see. What's hard is knowing where they end, knowing how long they go on. So I don't want to, it is a bubble. I feel confident about saying that. I don't want to say it's going to pop soon. It might be next year. It might require some other evidence. But we're starting to see that. And what Danielle described about the yield curve flattening, that's regardless of the absolute level of interest rates or the level of nominal rates, it's the spread that counts. In this case, this is called a bear flattener. So that's another sign of a recession, in addition to what the Atlanta Fed is putting out, and there's a lot of other signs around the world. So I always say, if the perception is here, the stock market is running on a narrative. If the perception is here and the reality is here, reality always wins, but it can take time. So yeah, I would expect to have some dry powder. But everything John said about cryptos is correct. I mean, I'm not a crypto advocate, but I don't own them and I don't recommend them. But I am a crypto student. I've been doing that for 10 years, going back to the original papers. I've been doing it for a very long time. I have some views that are probably the only one in the world. But having said that, if you like it, fine. In the 60s, there was a popular song called Shout, Shout, Knock Yourself Out.
Sure,
so if you want to go for it, knock yourself out. I think cash, like normal cash, has a role. People underestimate the embedded optionality. In other words, if you have cash and things fall apart, you can pivot. If you're in private equity, for example, good luck getting your money back from Henry Kravis.
Right.
Great firm, but they're not going to give you your money back. So people, they don't sell what they want, they sell what they can. But if you have cash, you're the person who can look around, you can pivot quickly, you can go shopping in the wreckage. So that basically it's not the money call on every asset class in the world. That's valuable, and people underestimate the value of the optionality, number one. Number two, it reduces the volatility of the rest of your portfolio. So if you have stock, gold, real estate, and so forth, you can sleep a little better at night. It's the opposite of leverage, in other words. So I recommend some cash, maybe a big slug, maybe 30%.
Cash ensures stable currency systems. It is not only the most secure means of payment and resilient in terms of crisis, it also reflects a nation's identity, as banknotes and coins are often a nation's calling card, valued by people beyond their monetary worth.
It's never set it and forget it, and that's actually part of the purpose of the cash. The time may come, we're not quite there yet, the time may come when you want to pivot from cash to 30% gold or 20% gold. Or maybe we'll get some good public policy. I doubt it, but if we did, there might be a time to pivot to equities. But that's the beauty of cash, is you can do that. And again, the embedded optionality is not well understood.